Hello, and welcome to the 2022 year-end review and overview provided by Advanced Asset Management Advisors. I'm Bob Baker, President of AAMA, and joining me today is our Chief Investment Officer, Phil Voelker. Hey, Phil, how you doing?
Good. How are you doing?
Very good. Hard to believe it's the start of another year and the closing of 2022. Before we get into a lot of details of some of our thoughts on the markets, I thought it would be best to take a couple minutes and review who AAMA is and what we do and why you should care. Um, AAMA is an independent and fundamentally rooted investment strategist, and we seek value by tilting portfolios toward attractive segments of the market through market pricing and sector valuation. And we've done this for a long time. Phil and I have been doing this for almost 40 and 45 years. And with our other investment staff, our average investment experience is over 30 years. And what we try to deliver is accessibility and collaboration and an investment process that's easy to understand, track, and discuss with clients. 2022 was a year of reckoning. Before the year started, a lot of the monetary authorities around the world dismissed the potential for inflation as transitory. And as the year rolled on, we all found out that inflation came back and really reared its ugly head. And while this helped money market fund investors because short term rates rose so much, this rising interest rate policy that the Fed uh, deployed really negatively impacted both bond and stock market values. Phil, would you take a couple minutes and talk about how the portfolios and indexes performed last year?
Sure. Um, as you mentioned, inflation became a problem, and we sort of saw the handwriting on the wall and started writing about inflation a couple years ahead, pointing to the tight labor market, supply shortages, extremely easy monetary policy, all coming together to stoke inflation. And on a 12-month basis, CPI as of November 30 was 7.1% year over year. There's several months during the year where that number was higher, some lower, but bottom line is inflation is a problem. And Bob, as you mentioned, rising interest rates are not friendly to security valuations. The S&P ended up being down 18 for the year, mid and small cap 13 to 16, foreign stocks in developed markets 14 and a half, and probably the most troubling and most historic were the losses in the bond market. The low yields that were forced so low by Federal Reserve quantitative easing set bonds up for historic losses. Long-term Treasury bond index lost 31%. The aggregate bond, which includes corporates and governments of all maturities, down 13. So if we stop there for a second and think about the traditional 60-40 portfolio, 60% stocks, 40% bonds, it had one of its worst periods ever. Looking inside the market, the worst performing sector was technology, down 28%, and the best was utility stocks with very stable earnings, of course, plus 1.6. One of the backdrops to this decline in value um, is what we look at as we call speculative asset returns. Digital asset ETFs, which are focused on the cryptocurrency market, down 71, 76%. IPO index down 57, and the SPAC index down 18. Of course, that only includes those that successfully completed a transaction. So, generational wealth loss in the speculative asset markets.
And the interesting thing is, the Fed had to deal with a number of issues, but talk a little bit for a minute about the PCE services index, if you would.
Sure, the services index makes up a large portion of consumer expenditures, and it is heavily impacted by wage costs. And with the tight labor market, wage costs have been rising consistently. Services costs have been rising consistently. And this was one of the key underlying inflationary factors back in the 70s, where it averaged, 10% plus or minus for basically a couple decades. And during that period of time, the Fed started periods of raising rates and then alternated with periods of declining rates, thinking that their job was done. They alternated back and forth several times, fits and starts, and it wasn't until the early 90s that services inflation really came under control and started to decline. It's a factor that markets, commodity markets, food supply, goods suppliers really can't affect. Normally, supply demand factors will adjust prices in energy and food and other goods, but the services prices is much stickier, and it is a long-term headache for the Fed. The Fed has multiple times, every news conference this year, said, we're not going to stop till our job is done. And they're haunted by the 2 decades of services inflation back in the 70s and 80s. So whenever there's speculation about a Fed pivot in the markets, it tends to be short-lived because the Fed has come out frequently and said, we're going to stay at it until we know that we've done the job.
And if we look at the 10-year Treasury bond yields going back to the mid 70s, which is the next chart, the crazy part about this is that, the 10-year Treasury bond peaked out back in 1981, and we've been in a falling interest rate environment ever since until really 2020. And during that same period of time, we've seen a tremendous decline in mortgage rates. And that fueled a lot of the speculation and appreciation in the real estate market in 2020 and 2021. But this is just almost a phenomenal long-term chart.
Yeah, it is, but it's also interesting. I mean, if you look at this chart, 10-year yield at 388 at year end, basically you go back to 2007, 8, and we're at similar levels as we were then. So the entire period from 2009 to date has been at extremely low levels on a historical basis. And even with the increase from 1.25 to the peak in October of 4.25, that increase is relatively small in the long-term trend.
Yeah, that is quite interesting. Let's move on to corporate earnings for a moment. If you take a quick overview of this for us, that would be great.
Sure. The corporate earnings, operating earnings for the S&P 500 in 2022 will probably post about a 4% decline versus the prior year. So, given the relative stagnation in the economy, it's not a bad performance. And in fact, part of that decline is simply some bank reserve provisioning. And interestingly, current estimates for 2023 point to a 13% gain. Now, historically, forecasts are a little bit optimistic, and they gradually come down as we get closer to quarterly earnings reporting season. So it's not too surprising we have a 13% gain. However, that gain of 13% used to be a lot higher. It's been trending lower. And for us, in some of our sector work, one of the most important things is how each sector's earnings trends are progressing. So at the peak of earnings expectations, the S&P 500 is now down only 3% from that level. However, telecom, which now includes the internet companies, down 14%, discretionary 12, technology 10. Those are some of the higher growth sectors in the market. So they are not only leading in price declines because of the interest rate increases, but they're showing also the highest degradation of earnings expectations. The more defensive sectors, staples down 5.5, healthcare 1.5, utilities up 1. That's not too surprising either, because historically they have much less volatile earnings. Those stock prices are generally lower, staples, healthcare, utilities flat, but not only that, their earnings are holding up much better than the higher growth sectors. We should also point out that energy earnings relative to the peak of the S&P 500 forecasts are up 80%. It's a very small sector of the market, but it is helping keep the S&P 500 in aggregate down only 3% in forecasts currently. So the key to us is the trend of these forecasts, how they change over time, and the market is paying attention to these.
And if we go to the next slide and take a look at forward price to earnings ratios, there's some really interesting parts of this chart too, if you could point those out.
Yeah, we spent a couple years in the 20 to 22 range for the PE multiple of the S&P 500, and that was during the recovery from the pandemic, when interest rates were zero on the short end and got down to 1.25 on the 10-year. Very lofty PE ratios from a historical basis. The peak at the beginning of last year at 21% quickly evaporated and got down to 15 by June. So the decline in stock prices in the first 6 months of the year was entirely based upon a change in valuations, which can be entirely attributed to the change in interest rates. After that, we've had a little double bounce between 15 and 17 as the market has rallied and declined 2 or 3 times now since June, as optimism about potential Fed change in policy enters and then leaves the market. So, a range of 15 to 17 sounds pretty minor, but that's a 10 to 15% change in prices, assuming that earnings are relatively stable. And so far, that's what's happened. We've had a relatively stable earnings environment, but prices have been swinging pretty widely.
And the fact that we've come back down to more historic long-term norms on PE ratios, that doesn't necessarily get us out of the woods, because if we look at the next chart and look at three scenarios, two of these are still pretty scary, don't you think, Phil?
Yeah, I mean, the middle scenario of stable expectations, if the market just went back to a 15, which is the lows of this last 12 months, and also really represents a long-term average for the PE ratio going back to the 80s, even further back than that, that's still an 11% decline in price if we simply retrace back to some of the lows we've had just recently. The more concerning look would be a 12 PE, which has been an area for this indicator to bottom frequently during periods of uncertainty about economic growth and earnings growth. So, if we were to see a 12, that's a price decline of nearly 30% from these levels, which would be near the low decline rate that we saw last year, because we were down 20 odd percent last year, high to low. And then obviously, if we went back to the perfect scenario of low interest rates, low inflation, gradual economic growth, the market would justify a higher PE of 20 to 21, which would give us a nice rally in stock prices. These are just a framework for potential valuations. The other key to this, of course, is what is the denominator? What is the earnings rate going to be? We've seen that decline for the market about 3%. Some sectors, double-digit declines. So this is sort of a moving target that is based strictly on price changes at the moment. If you start moving earnings around higher or lower, is going to impact these potential outcomes. And some people may say, well, that's a pretty broad range of potential outcomes. Well, it is, but we have to remember that interest rates, inflation, and even economic growth reports have been highly volatile over the last 18 months. If you look at the volatility of quarterly GDP, of interest rates, of earnings reports have actually become more volatile. We have a more volatile environment. So having a broader range of potential outcomes is not to be unexpected.
As we try to digest all the things that we've seen happen in the market the last couple years, and we enter into 2023, we tried to go through and list what ended up being about 12 things that we probably should remember as we go into 2023. And do you want to cover a few of these, Phil?
Sure, I think it's pretty obvious that the underlying issue for the markets is all wrapped up in inflation, interest rates, and Federal Reserve policy. Those have affected the markets and will continue to affect the markets. The thing to remember is that fighting inflation is normally a multi-year project. And as they have said several times, the Federal Reserve sees the biggest mistake they can make is backing away too soon from the fight of inflation. And as we saw 2 or 3 times in the last 12 months, optimism would creep into the market for a Fed pivot, and then it was blown away shortly thereafter. So optimism for a Fed pivot should be considered judiciously. Give them some time to measure their results, and don't be quick to jump on that optimism on a short-term basis. The other key things are, earnings expectations are declining. So as the denominator of that PE ratio, it is going to push PEs higher given an equal price. So that has a risk factor built into the market. The other side of this coin is that despite the high inflation, the American consumer is in relatively good shape, at least financially. Debt service ratios are historically low, and the labor market is tight. So anybody that wants a job can get one, and a lot of people are quitting jobs to take better jobs, increasing their income. So, it's a double-edged sword in that it's good for the underlying economy for the consumer to be in such good shape. But on the other hand, it does influence overall wages going higher and therefore making the Fed's job potentially more drawn out and tougher, certainly, in this kind of a period. So the key thing to remember is to stay away from companies that are extremely high growth expectations, because higher interest rates hurt those valuations most. And certainly non-earning companies, as we've seen in the crypto space, the SPAC space, IPOs, are to be avoided in favor of larger quality companies with more stable earnings growth, at least until we see the declining trend of earnings forecasts reversing. We think that's going to be pretty key.
And if we think back at some past cycles, there's been times where stock prices have gone up, but earnings have been going down. But sooner or later, that earnings has to be stabilized and go back up for the market really to get into a good growth pattern. Wouldn't you agree?
Yeah, I would agree. Forecasts have to be substantiated with reality. I'll put it that way.
Absolutely. It might be helpful just to take a quick overview of the equity and our fixed income portfolios today, Phil.
Yeah, the equity portfolios have been focused on large cap with definite overweightings in some of the defensive sectors, be it healthcare, consumer staples, utilities, that type of thing. And we're focused on companies whose, we looked at forecasts for sector earnings. We also look at the change in expectations on a company by company basis to make sure that the companies have stable or at least not dramatically falling earnings expectations. So it's a fairly, I mean, we have some growth exposure, but it's high quality, but it's focused on large cap for sure. The fixed income portfolios have been in short term maturities, and we've been positioned that way for several years because of the high risk in the bond market. We didn't know when rates were going to turn. We just knew that eventually they would, and the risk to principal in a rising rate environment is most devastating in long maturities and typically also in lower quality. So we've been short maturities and high quality for some time.
Well, Phil, thanks for going through these charts today and kind of giving some views on the markets. We would encourage advisors to call us if they have questions or would like more information regarding our portfolios and strategies. You're welcome to call myself at the information listed, or Aaron Plaskow, our National Sales Manager. And at AAMA, we believe in a high collaboration between advisors, and we're open to answering any questions or providing you with the information you need to be able to talk to your clients regarding our portfolios. So thank you.